Ladies and gentlemen, good day and welcome to Q2 and H1FY25 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Management of the company is being represented by Mr. Shishir Srivastava, Managing Director, Mr. Kailash Gupta, Group CFO, and Mr. Varun Parwal, Group President, Strategy, Audit and Head, Corporate Finance. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. At this time, I would like to hand over the conference to Mr. Shishir Srivastava. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. It's a pleasure to have you all here today to discuss our performance for the second quarter and half year ended September 2024. I hope you have had a chance to look at the results presentation shared by us. The same is uploaded on the stock exchanges as well as our corporate website. Let's start with an overview of our performance on a consolidated level. In Q2FY25, we achieved an operating revenue of 918 crore, a 5% increase year on year. EBITDA for the quarter reached 518 crore, up 2% year on year. To provide a more accurate picture of our core business performance, we have adjusted the figures to exclude the contribution of the residential business, which is inherently variable in nature. Excluding the residential business, we witnessed a 22% growth in operating revenue, which reached 870 crore rupees. EBITDA for the second quarter stood at 502 crore rupees, up 19%. Similarly, for the first half of FY25, adjusted for the residential business, operating revenues reached 1,742 crore rupees, up 23%, and EBITDA for the same period was at a historic high of rupees 1,027 crore, up by 20% on a year-on-year basis. This is the first time our EBITDA has breached the 1,000 crore mark, and we hope to see this trend continue and grow from here. Moving on to our retail portfolio, for Q2 FY25, retailer sales, that is consumption, for Q2 FY25 reached 3,279 crore, up by 24% year on year, driven by the fast ramp-up of the newly launched malls. On a like-to-like basis, which is excluding Phoenix Mall of the Millennium, Pune, and Phoenix Mall of Asia, Bangalore, we saw consumption growth of 5%. Retail rentals for the quarter grew by 22% to 474 crore rupees. In line with retail rentals, retail EBITDA also increased by 22% to 495 crore rupees for the quarter. On a like-to-like basis, in Q2 FY25, retail rentals and EBITDA both grew by 5% compared to the same quarter in the previous year. For the first half of FY25, retailer sales reached 6,496 crore rupees, up by 25% year on year. Like-to-like consumption growth was 6% for the first half of FY25, again excluding Phoenix Mall of the Millennium and Phoenix Mall of Asia from the mix. Retail rentals grew by 26% to 958 crore. Overall retail EBITDA for H1 was 1,010 crore, up 27% year on year. On a like-to-like basis, retail rentals grew by 6% and EBITDA grew by 7%. Phoenix Mall of the Millennium and Phoenix Mall of Asia, which have been operating for nearly a year now, have demonstrated excellent consumption growth, each approaching the 500 crore rupee mark in the first half of the financial year. Looking at category-wise performance, jewelry was our top performing category for the quarter, with a growth of 33% across the portfolio on a like-to-like basis. Gourmet food and hypermarket saw a growth of 12% during the quarter. FEC and multiplex declined by 15%, primarily due to fewer blockbuster releases during the quarter. Moving on to the occupancy highlights. In September 2024, leased occupancy across our major malls was at about 97%, and trading occupancy was almost at about 92%. Our newer malls have seen a fast ramp-up in trading occupancy, with Palladium Ahmedabad, which has achieved a strong trading occupancy level of 94%, with the multiplex commencing operations in Q2 FY25. Within almost a year since launch, Phoenix Mall of the Millennium has reached a trading occupancy of 87% in September, and Phoenix Mall of Asia saw a trading occupancy of 78%. We also have substantial area under active fit-outs, and both these malls are on track to cross trading occupancy of over 90% in the coming months. Our future plans: we are committed to enhancing the performance of our existing malls through active mall management and exceptional customer service, with a focus on bringing the best and the latest brands and elevating customer experience by adding more F&B and entertainment spaces. We are making significant progress towards the launch of the retail block opposite PVR at our flagship property, Phoenix Palladium, Lower Parel, Mumbai. Retailers have commenced fit-out activities, and we anticipate operationalizing this 250,000 square feet retail GLA by the end of 2024. Our development pipeline remains robust, with approximately 3 million square feet of retail space currently under development and slated for completion by FY27. Further, I am pleased to share that our phase 1 of our new city center lifestyle destination in Thane will feature a destination retail development in the range of 1.2 to 1.5 million square feet of leasable area. This is as per the plans which are currently under design development. And we continue to have more FSI potential to develop other asset classes in subsequent phases. With the recent land acquisitions in Bangalore, Coimbatore, and Chandigarh, Mohali during 2024, we continue to build out a strong pipeline of retail-led mixed-use destinations going up to 2030. Looking at our commercial offices business, as of September 2024, occupancy across our operational office assets in Mumbai and Pune stood at almost 70%, with gross rentals averaging around 118 rupees per square foot. During the first half of FY25, we achieved gross leasing of approximately 150,000 square feet across our operational office assets. For Q2 FY25, income grew by 19% to 54 crore, and EBITDA was at 34 crore rupees, up by 31%. For the first half FY25, income stood at 105 crore rupees, up 17%, and EBITDA grew by 31% to rupees 66 crore. The growth in the segment was led by improved rent-generating occupancy at Art Guild House, Mumbai, and Fountainhead Towers in Pune. Looking ahead, we have initiated pre-leasing activities for Phoenix Asia Towers in Bangalore. The construction of this asset is complete, and we are awaiting the occupancy certificate. We are also nearing completion of our offices in Pune, which are Millennium Towers, and also in Chennai. Our office developments in Bangalore, Pune, and Chennai will take our commercial office portfolio to nearly 5 million square feet. Our hotels have delivered a stellar performance this quarter, with the St. Regis leading the way, where occupancy improved by 3 percentage points to 85% for both Q2 and H1 FY25, driven by increased corporate events and wedding festivities in the city. This led to a 15% growth in the average room rate to rupees 17,320 and a 19% increase in RevPAR to rupees 14,694 for Q2 FY25. For the first half of the year, ARR and RevPAR at this asset grew by 7% and 11% respectively. At Courtyard by Marriott Agra, occupancy for Q2 FY25 stood at 67%. The property achieved a 9% growth in ARR, reaching 4,569 rupees, and a 5% increase in RevPAR to rupees 3,044 during Q2 FY25. Looking at our residential business, for the first half of FY25, the business achieved gross sales of 78 crore rupees and collections of 125 crore. The average sales price across our two residential assets, one Bangalore West and Kesaku, both in Bangalore, is approximately 26,000 rupees per square foot. We currently have approximately 390,000 square feet of ready inventory remaining to be sold at these two projects. This brings me to the end of the performance update across our businesses. Here's wishing you all a happy Diwali and a prosperous New Year. I would now like to request Kailash to take you through the financial performance.
Thank you, Shishir, and good morning, everyone. Let's begin with the financial performance of our standalone business.
Sorry to interrupt, sir. Sir, can you come a little bit closer to the microphone?
Okay. Is it better?
Yes, sir. Please go ahead.
Let's begin with the financial performance of our standalone business. The Phoenix Mills, on a standalone basis, primarily consist of the Phoenix Palladium and a small component of offices at Phoenix House. For Q2 FY25, income from operation reached at 116 crore, a 3% increase over the same period last year. EBITDA for the quarter remained steady at rupees 72 crore with a margin of 63%. Moving to our consolidated business, last year we realized significant revenue and profit from sale of ready inventory in our Bangalore residential projects. Additionally, the receipt of OC for Tower 7 at 1 Bangalore West boosted our revenue. Adjusted for the resi business, consolidated operational revenue across the annuity portfolio for the quarter was 870 crore, growing by 22% year-on-year basis. Consolidated operating EBITDA, excluding resi business, grew by 19% Y-on-Y basis, reaching to rupees 502 crore in Q2 FY25. Updates on our debt and liquidity position. I am pleased to announce that PML credit rating was recently upgraded to AA positive and with a positive outlook, reflecting our growth trajectory and disciplined financial approach. As on September 2024, our liquidity position was at rupees 1,974 crore. Compared to March 24, our group level gross debt increased marginally by 13 crore of 2,4379 crore. Our group level net debt position improved to rupees 2,405 crore as on September 2024. The net debt to EBITDA ratio remained healthy at 1.1x, and we have successfully reduced our average cost of debt to 8.67% in the September 2024. We remain committed to reducing debt and optimize our cost to debt ratio basically. Notably, all of our recent land acquisition has been funded entirely through internal accruals. Just to give you the perspective, our total capex in the first half was at rupees 1,380 crore, which includes the land acquisitions of rupees 740 crore and a construction cost of approximately 640 crore. The entire funding is done from the equity participation from CPPIB at 270 crore, and the balance was funded through the internal accrual. So this shows the discipline, kind of discipline which we are following in the business side. On a cash flow, for the first half of FY24, we generated a net cash flow of around 1,000 crore from operations, and during Q2 FY25, we generated a net cash of 486 crore from the operations. To provide further context, after accounting the interest payment on our existing debt, our operating free cash flow, net of taxes and interest, was at 380 crore. Excluding the resi business, the operating cash flow for QY FY25 stood at 378 crore, a 24% increase from the same period last year. With the upcoming festive and winter season, we remain optimistic about our performance in the second half of the year. We have a strong development pipeline in place extending up to 2027. With recent acquisition in Thane, Bangalore, Coimbatore, and Chandigarh, we now have a pipeline visibility going up to 2030, which we'll announce maybe in, very shortly. We expect to double our operational annuity portfolio area between now to 2030. Leveraging our strong balance sheet, we are committed to delivering our under construction projects on time and deploying capital judiciously to expand our portfolio. This brings me to the end of the financial performance update. Wish you all a very happy Diwali, and let's get into a Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much, and congratulations on a nice ramp up for your new malls. My first question is, if you can give some color on what you're seeing in the first 25 days of this month. How is the start of the festive season and this month been in terms of consumption levels?
Hi, Puneet. Thank you for your question. This month has been a bit of a mixed bucket in terms of performance across the country. With Chennai and Bangalore seeing the heavy deluge, we have seen quite an impact on consumption, perhaps to the extent of about 20 crore or so because of the rains itself. Mumbai, Pune seem to be pretty much moderate so far, but starting yesterday with the 2 weekends of the festive season, we are quite geared up to see high footfalls and high consumption. Also, as you are aware, even in times where one generally has been seeing a decline in sales across retail brands across the country, not just in our portfolio.
Yeah.
We drive consumption slightly differently, and therefore we've not seen a degrowth. We've only seen a positive growth. As we mentioned, like-to-like growth, excluding Mall of the Millennium and Phoenix Mall of Asia, Bangalore, like-to-like growth is in the range of about 7 to 9%, averaging there. And this is for the month of October, despite the rains in Bangalore and Chennai.
Understood. That's helpful. Just a small observation here. In your others category for last quarter, there's a sharp 21% decline. I know it's a small part of your overall business, but what all does it capture?
What all does others capture?
Yeah.
Others income would be parking income, marketing income, and event space rentals, etc.
Okay. Understood. And secondly, if you can comment upon, you've done 3 acquisitions of late and some progress on Thane side as well. So Coimbatore, Mohali, Thane, if you can give some sense of what are the rentals on which you've underwritten the retail portfolio and what is the total area you're looking to build there?
So I would like to put it like this, that we are looking at our business plan is underwritten with conservative rentals, right? But despite that, I would say that by the 3rd year of operation, we should be in the range of about a 14% yield on cost. We have underwritten the rentals looking at what are the rentals in competitive malls in that vicinity, and we've kind of just used that as our base approach, though we typically track maybe 15% higher than what the market average would be.
Understood. Lastly, if you can comment on the progress on your office leasing side.
Office leasing has seen a good progress. As you can see, our EBITDA, our gross revenue and EBITDA is up significantly compared to the previous year. We are waiting to get the OC in Bangalore. It's about 800 odd thousand square feet of GLA. We have transactions which are in place and will get executed soon after the OC for about 200,000 square feet almost, and a lot of discussions in pipeline. Historically, Bangalore has seen the highest ever leasing in the country in this first half in this financial year, and we are happy to see the traction find its way to our asset as well.
Okay, and Pune side?
Pune is still under development. I think we may be about 6 months away from OC. So we are also actively in the marketing phase there. There has been a lot of site visits, a lot of RFPs which are under discussion now. So we will report, as soon as we have confirmations, we will let you know what area has already been signed up.
Understood. That's very helpful. Thank you so much and all the best. And wish you a happy Diwali.
Thank you.
Next question is from the line of Praveen Chaudhary from Morgan Stanley. Please go ahead.
Thank you so much for taking my question. Hi, Shishir. Hi, Kailash. Hi, Varun. Congratulations on, again, good results. I'm looking at just one number, and I'm trying to decode as much as possible, so please indulge if you can. So I'm looking at the PATMI number, which is net profit after minority interest. And when I look at last quarter, it was down 3% year over year. This quarter is down 14% year over year. Again, obviously there is a residential angle to it. So two questions there. One is, how should we think about the residential business margin for you? Is it a 5% margin net business or 15%? And then second thing is that you have given us excluding residential EBITDA growth, I think probably for the first time. Would you ensure that you will continue to give, or can you give retroactively before, so that that's a real way to understand the growth? And the reason there's a disconnect between these two, because if you remove the residential part of the business, it's nicely growing the IP business, both in EBITDA and revenue terms. But as I said, in PATMI, even if I remove the residential part with some assumption of margin, it still shows year-over-year decline. So can you just help us reconcile that? Thank you.
Okay. Praveen, I'm going to try and respond to a couple of questions, and a few you'll have to repeat again, because that was a long list of many questions. Firstly, yes, in Q1 we had disclosed the EBITDA numbers without excluding the resi business, and we will continue to do that as we've done in Q2 as well and going forward. I just want to clarify that for us, the resi business, and today it primarily comprises of that balance inventory of about 350 odd thousand square feet, 390,000 square feet in Bangalore. Our margins are in the range of about 40 to 50%. So it's not a declining margin business for us. This is all ready inventory. We've already incurred all the costs there. Even when we are looking at the development in Kolkata, the residential development in Kolkata, the margins are, would be similar in the similar range, or maybe 5-10% here, lesser than that. But it's not a 5 or a 10 or a 15% margin business for us. Would you like to repeat your other questions?
Sure. Both are helpful information. I was not talking about EBITDA margin. I was thinking of net margin, because one of the main question I have is, your EBITDA growth is fine, like for like or excluding residential. That's very strong. We are talking about PATMI growth, which is where, because of minority interest, maybe minority interest is growing very fast. Those malls, which are JV projects, are doing very well. That's why there is a disconnect between the speed at which you're growing on the top line and EBITDA is not showing up in my net profit line. And I'm trying to reconcile it, and that's why I was using that. Yeah.
A few lines on what has impacted the net profit margin. One is our liquidity has reduced, so our other income from interest and investments, etc., has certainly reduced. The taxes have gone up because in many of our newer malls, we have we don't have any debt and or very nominal debt, so the tax impact is high. In the older malls, we have utilized accrued losses, so taxes have started increasing. So these are a few of the lines which have impacted our net PAT, if you were to look at it. I didn't quite get the point on the JV businesses because we do consolidate all the numbers. We own majority, more than 50% in all of our JVs. So we are consolidating all the lines there. I don't think that, but if you look at, perhaps you're looking at after the, minority shareholders interest. So yes, there is a, in the case of the CPPIB JV, there is a 49% sharing of there. And in the case of our joint venture with GIC, there is a 33% share that they have. Having said that, I would also like to point out a very interesting fact here. All of our operating assets, excluding the ones which are new, where we have certainly built out all the remaining asset classes, but all of our assets which are currently generating 200 plus crore of revenue or of rental income or even EBITDA, they are being these numbers are coming out of about 1 million or 1.2 million square feet of GLA, and all of them have the potential of additional FSI, which we are exploiting and we are constructing and building, and they will each become developments in the range of 3 to 5 million square feet. So you can imagine the potential growth arising out of these additional area, which is all which are all annuity assets. For example, if you look at Phoenix Market City, Bangalore, we have about 1.2 million square feet of retail space currently. We are adding another 500 odd thousand square feet. We have the Grand Hyatt Hotel coming there. We have the offices block coming there. Plus, we've acquired the adjacent land, which once we are able to amalgamate, that will give us a further potential of another 2 million, 1.2 million, 1.5 million, somewhere in that range. So the incremental cost for developing these asset classes are very low because we own the land. Yes, you are paying for premium FSI and construction, but the return or the yield on all of this is going to be significantly higher. And all of this is playing out between now and 2027, where we've explained how our portfolio is going to grow. So this is an important fact that I would like you to bear in mind, which will obviously have a significant impact on our PAT going forward.
Makes sense. Thank you so much. I mean, I guess the strategy is unquestionably correct. We also see that recent land acquisitions will ensure the visibility till 2030 in terms of newer malls and newer offices coming through. Some investors do ask, is there a gap between now and 2027? And probably that you were trying to answer that question by saying some of the FSI you will exploit. But is there something you want to talk about between now and 2027 when either Surat or Kolkata comes through, and after that it looks very smooth, that we can see some slowdown, meaning that there is the gap between the reported growth and the like-for-like growth will narrow, means they will be similar, which will reduce the overall growth for the company. We understand the office coming through, and we understand the Palladium extensions coming through, but still it won't be same as what we have seen in the last 12 months, where you have 4 new malls coming in. Is there anything to fill up that gap?
Yes. So offices are all, as you mentioned, offices are all going to be operational between, let's say, we should get the OC in about a month's time in Bangalore, 6 months' time for the first phase in Millennium Towers, another 4 months thereafter for the second phase of Millennium Towers. So incremental area, and of course Chennai as well. We have another 500,000 square feet of offices in Chennai which will come online. We have Palladium, as I mentioned, another 250,000 square feet which will be operational very, very soon. So over the next 24 months, I think every quarter you're going to see maybe 250 to 300,000 square feet becoming operational of either retail or office. So I think that these are certainly going to help bridge the gap. There could be maybe a 1 quarter, impact because between leasing and trading. So one can safely assume that there is a significant growth coming out of these inorganically through these expansions.
That is very reassuring. Thank you so much. And again, happy Diwali in advance to everyone in the management team.
Thank you so much, Praveen. Happy Diwali to you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We'll take our next question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi Shishir. Congratulations on a decent quarter. So Shishir, my first question is on consumption. So we have seen a decline of 4% in Palladium, 2% in Bangalore. So Pune also 5% and 3% Palladium. Chennai. So I just wanted to understand if you can help us with some data points say over the last few months. So how has been the revenue share and the minimum guarantee tracking? So is there a divergence building between the two now because of the slowdown in sales of the retailer? And will that in any way impact will they come back to us and negotiate again for a lower rate if they are not able to do well in their portfolio?
Hi Parikshit, thank you for your question. So in the last 12 months, generally I would say minimum guarantee at an average across our malls may have gone up by about 10%. And as we know that, in the last quarter or last 2 quarters, retail consumption has been muted. We've seen a growth in our malls. It's not been there pan-India in other standalone stores, etc. But so I would say a 5% growth, 5 to 7% growth is what we have seen. Consequently, because the minimum guarantee, and you are very well familiar with our model, Parikshit, every cycle of 3 years, you see that, MG moves up and catches up with the incremental rent that we get out of the revenue share. So it takes another 2 quarters or 3 quarters before the revenue share starts moving up again. So perhaps we may see an impact of the slow consumption across the country, but we are confident that with our initiatives, it may be a 2 quarter lag, but again we will start seeing incremental rent being contributed out of revenue share as the consumption moves up.
Okay, but you are seeing some divergence between the two. So revenue share is tracking down and MG is tracking higher. So what's this period?
No, it's not tracking down or tracking higher. This is the way our model has worked over the last 20 years. Every 3 years, you see a significant jump as you end as contracts near end of tenure and you enter into renewals, or even within 5-year contracts at the end of 3 years, there's a significant jump in MG. So this is the way the model is. MG moves up, then it takes and catches up with the overall rent that we were deriving as a combination of MG plus the incremental rent from rev share. So when MG moves up, it catches up to that. That becomes the new base, and and over a period of 2 or 3 quarters, consumption then tracks up and starts contributing further incremental rent. See, typically we've always seen an average of incremental rent being in the range of about 11-12% over and above the minimum guarantee. So we remain confident that over a period we will be at that. We will continue to be at that.
Okay. The second question is on the multiplexes, which is about 14% of the trading mix, and F&B 11%. So in one edge, we have seen both multiplexes tracking down by almost 11% in consumption, and F&B has been muted 0 to 2%. So they take up almost 25% of the area, but they are not growing, and both are interrelated. Though they contribute very low, I mean, mall multiplex is about 4% to the consumption, but still occupying a lot of space. And we are not been getting good content, I mean, blockbuster content of late for some time now. And I think you did mention that you are looking at adding more area under this umbrella. So given that, so how do you see growth coming in when large part of the area will not contribute towards rental growth or consumption growth?
Hi, Parikshit. Varun this side. I think just clarifying on the first part, family entertainment centers, which comprise of retailers like a Time Zone or a Play and Learn or Game Palace or other gaming centers, is at about 5 to 6% of our overall retail leasable area at this point in time, and multiplexes are at about 8 to 9%. The family entertainment centers, of course, have been seeing a very strong growth, and they have been acting as crowd pullers, and they have been helping us increase the dwell time that consumers have. And multiplexes, for reasons that have been discussed in various other forums, they have seen a bit of impact on consumption because of the sort of content that's coming out. But I think as we look forward, we see the content pipeline increasing and improving, and we are seeing a lot of blockbuster lineups scheduled now for the period from November to March. So we are hopeful that we are through the worst of the cycle for the multiplexes, and going forward we should start seeing improving numbers. And at the same time, with our family entertainment centers and our own in-house fan power and open spaces, we have done a lot of events for which the response has been phenomenal across cities, and that continues to act as getting people an experiential revenue to come and spend time in the mall.
Okay. Just on that, this is the last question on this Thane thing. So now we have 2 large malls in the vicinity from about 2 kilometer radius, and I understand one of the peers who has bought a land nearby is looking to sell, is in the market to sell the land where he was planning to build a multiplex. So what gives us confidence that in a market where already 2 large assets are there, one peer is looking to exit? So what gives us confidence that again we can repeat a Phoenix Market City kind of a model in this macro market?
Yeah, I think it's going to be it's going to be an interesting development to see how Thane is shaping up. We believe that Thane does have the size of the market who can absorb another 1 or 2 million square feet of retail GLA. We are going to clearly build something which is best in class, new age. We are going to be leveraging our relationships with the brands to get the best brand mix over here. When we purchase, typically before we acquire any land, we do extensive research and extensive discussions with our brand partners who lead the mall occupancy, global and Indian brand partners. And we have a lot of interest from the best of brands to be a part of this mall. We are very, very conscious of the competition there, and clearly our efforts are going to be to build the best asset that there is in that micro market for time to come, and that should that will be the foundation of driving our success.
So what will be the rentals here, kind of starting rentals?
So we have underwritten our rentals in the range of about 175, but that's only for the business plan and for for the acquisition evaluation and feasibility. We are confident that the market is going to be closer to about 180 to 200 in that range. And I think that puts us in a very, very, very good space.
Okay. Okay, Shishir, thank you and wish you happy Diwali. That's all from my side.
Thank you very much. Wish you a very happy Diwali too, Parikshit.
Thank you. We'll take our next question from the line of Parvez Qazi from Nuvama Group. Please go ahead. Mr. Qazi, can you please unmute your line?
Yeah, hi. Good morning and thanks for taking my question. So my first question is regarding the Thane land parcel. When do we see the completion timeline for the mall which we intend to develop in the first phase? Second is with regards to the Kolkata residential project, what could be a potential launch timeline there? And third, at a slightly broader overall level, I mean, slowdown in urban consumption has been talked for now last couple of quarters. We have in fact done quite well. So what additionally can we do in terms of either category mix change or other things which we can try to kind of tackle this situation? Thank you.
So Thane, if I may just clarify, Parvez, your first question was on Thane. I couldn't hear you very clearly.
So the completion timeline for the Thane mall.
Okay, so we are currently, in advanced design development stages. I think we will go into approvals maybe in the next month and a half or so. Typically, it may take a quarter or so to get the approvals. I would think that we should be in a position to break ground in about 6 months from now. Typically, the first phase, which is the mall, takes about 4 years to build out. And so in about 4.5 years, one can expect that, the mall will be ready for retailers to do their fit outs and soon after that commence their construction operations.
Sure. For the Kolkata residential project?
Kolkata residential, we expect to launch this in Q1FY26, sometime in April next year. And the pre-marketing activities will start even probably in the last quarter of this financial year.
Sure. And regarding the overall urban consumption things, what can be done?
We will continue to focus on what we do best, and which is make sure that, we've continually been very innovative in the way we are driving the right profile of customers to our mall and driving consumption. And we're going to continue to do that. We have some excellent lineups of some large, events, performances at all our malls with great artists, a lot of F&B based events. We did, I don't know if you're aware, we did the MasterChef event in Bangalore where we had the erstwhile judges from Australia visit us, and this ran over 3 days. All 3 days were sold out. Tickets were priced at 6,000 rupees a head, and they were all sold out. So these are the quality of events that we run there, which drives the, which drives consumption. Over and above that, we have the best of artists performing across our destinations. We have the best experiential events, decor, which all is driving consumption. So we will continue to do that and continue to do that the best way we can. Which is why, again, if you just correlate with retailers' pan-India consumption and versus their store consumption recorded by their stores in our malls, you will see that they track far, far, far better than they do across the country.
Sure. Thanks and all the best.
Thank you.
Thank you. Before we take the next question, would like to remind participants to press star and 1 to ask a question. Next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Thanks for taking the question. Again, just on the consumption side, right?
Sorry,
so if we look at the...
Can you use
Hello?
the answer
Is it better?
Yes, Kunal, please go ahead.
Yeah, sure. So just on the consumption side, so if you just consider like the malls which have been stable, right, in terms of say occupancy is about 90%. So if you exclude say Ahmedabad, which saw uptick in the occupancy as well as trading density, the overall consumption, rather same store consumption, was like say less than 3% up. Right? How does this how should one look at this number going ahead? I remember in the past you've spoken about your mature malls should clock somewhere in the range of like double digit consumption growth on a steady state basis. How do you look at this number now, in context of the slowdown that we are seeing overall in consumption across India? I understand your consumption at your malls is doing better, but overall slowdown is there. So how do you see this number for steady state malls going ahead?
Kunal, you have to actually look at historically how we've trended over the last 15 years. And we've typically been in that double-digit growth for the last 15 years. It's not. I believe that with our, simply with the way people, the way our shoppers are growing in numbers over a period of time. I think this, to me personally, this may be a blip for a couple of quarters, fueled by many reasons. Whether it is, the pricing inflation in retail, whether it is generally we had elections and you had dry days and all of that this year. I think it's a blip that one may see for a couple of quarters. But again, over the long run, we remain confident to see double-digit growth in consumption across the board. And we are conscious of the fact that as the malls age, as the market actually continues to, at some point it's not going to keep growing, but there is going to be some kind of a leveling off in consumption trends. So we focus on how we're going to grow the business, and we continue to focus on looking at new geographies where we can enter. And I think that strategy has played out well in times where organic growth has been moderate. But we are seeing that the contribution due to inorganic growth has taken our overall consumption and overall rentals and EBITDA up. That strategy continues to play out.
Okay, and just to understand, this so 10% double-digit consumption growth. How do you break this up in terms of say in terms of pricing led, in terms of volume led, volume of footfalls led? How do you break that up internally for yourself?
Okay, so if we just look at Phoenix Market City, Mumbai, right, which has recorded double-digit growth, we've seen the contributors to that would be new retailers that we've added like Uniqlo, etc. So you're bringing in new brands and new categories as well. We've seen F&B with the cafes and bars showing a significant increase in consumption. Return to, I would say, the multiplex is awaited because that I think is going to fuel more consumption. But hopefully with new blockbusters being released, that will play out well. We got Decathlon in at Phoenix Market City, Kurla again, which is under fit out. This is going to certainly bring in a different category and a new brand in, driving that. And interestingly, as the occupancy of the offices continues to grow, that keeps adding, captive audience to the mall for the entertainment and F&B. And that category, that again is going to, aid consumption growth. So similarly, again, as we see the office occupancy of Fountainhead Tower 3 in Phoenix Market City, Viman Nagar, that will aid consumption as well. As Phoenix Asia Towers, 800,000 square feet get occupied in Bangalore, that will aid the consumption at Mall of Asia. So there are multiple strategies at play here, which help us, get into a 10-11% kind of a growth.
Sure.
And my second question was on the tier two city opportunity, right? I mean, we have seen some capital deployment there in the last few years, and particularly in last quarter also, Coimbatore and Chandigarh. So how should we look at incrementally, on the capital deployment side? How much would be the focus towards tier two towns? And just an overall, just view on the whole.
We've been very clear about our growth strategy and cities which are of interest. I think it's repeated in every investor presentation, and we are simply going with that and checkboxing that. You can see Thane, Coimbatore, Chandigarh have been checkboxed. We still are looking for options in Hyderabad, NCR, Navi Mumbai, Goa, Jaipur, Kochi. These are markets that we believe are, well worth our investment, and we'll see. We should achieve our target growth of target yields of 14-15% on mall stabilization in each of these locations in the after 3 years of operations, and steadily increasing and going up to 20% thereafter. So we've been quite clear. If you are asking us what is our tier 2 strategy, just look at the slide number 10 on our presentation, and that I'll make the sorry. Which presentation? This is in the corporate presentation. Look at the slide number 10 of our corporate presentation, and you will see the cities of interest. These are the cities that we are focused on.
Sure, understood. Thanks so much, and all the best.
Thank you.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. On behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.